So kind of where the market goes next is going to be important. Do we break out to the upside and head up towards 7,100, or are we going to have a bigger correction between now and summer? Entirely possible, get a 5 or a 10% correction here that works off some, and again, we might see that across maybe all asset classes at once. Maybe we see, the market just kind of reset itself. Metals go down, stocks go down, whatever else, emerging markets and small caps and mid caps, they all kind of get hit at the same time. And you just kind of get this risk off move in the markets that resets the markets 5 or 10% lower and gives you a much better entry point to put money to work.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you here at the end of another week for another weekly market recap featuring my good friend, the gravitational portfolio manager, Lance Roberts. Lance, how you doing?
Are you saying I'm getting fat? Like I'm getting my own orbit now? I mean,
I was thinking more ego, just your ego's
uh,
so big it
yeah,
has its own gravitational
yeah, it
field.
has, it definitely has its own gravitational pull for sure.
Yeah. No, I was actually thinking there's a number of assets for which gravity seems to suddenly be taking over. Precious metals will obviously be one of the ones we talk about today. But there are a few others that you were even just mentioning to me right before we turned the camera on. And actually, why don't we start with that, Lance? So you and I have talked about how, pretty much since late fall, right?
Mhm.
Like October, um, the hyperscaler haven't really gone anywhere,
Right,
right? And therefore the S&P hasn't gone, it has been very range bound.
right,
Did manage to hit an all-time high, but that's kind of been within a relatively narrow range.
right,
Um, we just saw something this week we don't see very often, where we saw Microsoft down like 11%.
right.
Um, and so I'm curious for you, how much is that grabbing your attention? Not just because a big company's down 11%, but sort of as a bellwether for perhaps some other challenges to the AI trade going forward.
Well, again, things are always in the short term very psychological. There's a particular trade that's going on or whatever's happening, right? So either up or down, right? So, and it kind of draws in investors into that, right? So AI had a great trade last year, got extremely overbought. So we've been going through this correctional process. And if you actually look at, strip away the data move, right, in terms of the price move on Friday and or on Thursday. And if I said, let's just go look at these numbers of these companies, and I'm going to tell you who the name of the companies are. If I told you
Hmm.
there was a company that was trading at a 22 times forward PE with a PEG ratio of 1 that was growing earnings at 39% a year, you go, I want to own that company. Well, that's
Hmm.
Microsoft. And and so the earnings for these companies are stellar, but they, as I've noted many times here with you over the last couple of months, expectations for 2026 in terms of earnings growth and those type of things are extremely optimistic. So any little bit of a miss, which is in Microsoft's case, this is all it was a kind of a little bit lighter guidance than what the street was expecting. And so you have this immediate knee-jerk algorithmic move of, assets getting dumped. And again, if you looked at the price action yesterday, the stock was down about 12% intraday. And every time it got down to that level, you saw a lot of buying coming into the stock. So buyers were there to pick up the stock price. The stock closed down like 9%, 9.5% by the end of the day. So you saw that buying into the stock at that level. So, investors that are paying attention to valuations, they're starting to accumulate shares of these companies at these levels. And again, this goes back to our conversation last week. Investors want to buy what's going through the roof, but they don't want to buy what's coming down, which is becoming a much better value. And so, there's a lot of these companies now that are getting relatively cheap on a fundamental basis. You should be wanting to buy them, but instead you're chasing other assets.
Okay. So one of the intents of the question was, as you and I have talked many times over the past 2 years, the AI trade's been really pulling the indices along the past couple of years. And if all of a sudden Wall Street sort of falls out of love with the AI trade, obviously that could has the potential, not the guarantee, but the potential to do a lot of damage in the markets. It doesn't sound like you're seeing this yet as any sort of like fundamental breakdown in the AI trade. It's just more some of the froth is being taken off.
Yeah, I mean, look, if you look at the market as a whole, again, these companies make up roughly 40% of the index, and the market's off maybe 1% from its all-time high right now. So,
Mhm.
there's not there, while you can pick on and again, you look at Microsoft, it's like, okay, here's the story. Microsoft down 12%. Meta was up 12%.
Yeah, and this was my question, like, is there a contagion risk? And it sounds like right now you're not too worried about one.
Yeah, no, and you're not seeing it because again, you look at these earnings, they're just phenomenal. I mean, these companies trade at very low price to earnings growth ratios right now. And so even if you look, here's a good example, Nvidia. Its PEG ratio right now on a forward basis is 0.5. If I slash Nvidia's earnings growth in half and I say they're only going to grow at half the rate that's expected right now, it's still a PEG of 1.
Okay.
So, so this is so the point about all this is that as investors, go back to the fundamentals. Forget the narratives. The narratives are what get you in trouble. They keep you out of stocks you should be buying, and they get you into stuff you shouldn't be buying. And then you get these massive reversals that actually cause you a lot of problems. But our job is to always buy cheap and sell expensive. But as investors, we always do exactly the opposite. We want to buy what's expensive and sell what's cheap.
Right. And this is why we talk about working with an advisor because the advisor helps keep you Vulcan, right? Just focusing on the numbers and the stats versus getting caught up in the FOMO or the fear.
Yeah.
All right, real quick, just because you mentioned it today, and I think you mentioned in the past, I don't know if we've really defined it for people. So when you talk about PEG, the PEG
Right.
ratio or the price to earnings growth, um, I just want to make folks really fully understand what you're talking about there. So most people are familiar with the PE ratio or price to
Mhm.
earnings ratio, and it's just sort of a
Right.
way that we value stocks, where in theory, a company should be worth the discounted stream of its future cash flows, right? And there's a lot of math that goes into that. But companies end up just trading, at whatever they trade at. We know what their earnings are because they have to report that every quarter. And so we can very easily calculate a price to earnings ratio. And then over time, we kind of look at, all right, well, what's sort of the average price to earnings ratio that the market trades at or that stocks in a certain sector trade at? And we kind of use that to determine if they're getting richly priced or not, right? The PE
Mhm.
ratio is 50% higher for the sector than it normally is, right? Or for this stock is higher than the rest in the sector. Maybe that one's a little bit richly priced. Um, it's not it's a finger to the wind type of thing. But not all PE ratios you could say are created equal, right? So if two stocks are trading at say a 25 PE ratio, um, one may not be growing its earnings much at all, right?
Right.
One might be growing its earnings an awful lot. You want to own the one that's growing its earnings an awful lot because you expect its earnings to be even higher next quarter, next year. And so, the company is creating more value over time. So
Yeah.
when you look at price to earnings growth, that kind of takes that factor into account. And so,
Right.
what you're saying is yeah, some of these companies really kind of richly priced on a price to sales ratio. But if you look at them at something like a price to earnings growth ratio, they could be downright cheap. And I think you've said NVIDIA is a good
Yeah.
example of that.
Yeah. Well, here, let me share this with you real quick. This is just a heat map of the market. FinViz does a really good job of this. So this is the market in terms of PE ratios. So this is trailing PE ratios for these companies. So Nvidia right now trades at a 47 times PE. So you go, oh my gosh, it's really expensive. Walmart trades at a 41 times earnings. Costco's at nearly 50 times trailing earnings. So, you look at the market as a whole and go, wow, the market's really, really expensive, with the exception of some banks over here and a couple of energy companies, and of course, communications, Verizon, and AT&T. They're pretty cheap. So you look at the company from the market from a PE basis, and you go, wow, these things are really overbought. Everything's going to crash, etc. But when you're taking, and if we change this to forward PEs, we get a little bit different picture. Companies that you consider now extremely stable, right? So you think about, I want defensive stocks in my portfolio. So I'm going to own a Coke and a Walmart and a Costco. So this is forward PEs. Nvidia's at 24, Walmart's at 39, 40, Costco's at 42. Tesla's at 506, 160, so there's some pretty expensive one here. Amazon's at 30. But again, this is all based on what expectations are for just this coming year. So what I really want to know is, to your point you were just making, is how are these companies growing earnings? Or do, for instance, if I take a look at Apple as a good example, for a while there, they weren't growing revenues. Now that's changed just recently. We're starting to see a little bit better revenue growth out of Apple. It's becoming a bit more attractive, which is one of the reasons we just added a small trading position to our portfolio. But when we start looking at how fast these companies are growing earnings, now I can start to look forward and say, okay, if these companies, and again, NVIDIA was the example I was using a second ago, I can cut the earnings growth rate of NVIDIA in half, and the stock still trades very cheaply relative to what's expected for earnings growth from this company going forward. So if we change this dynamic to PEG, all of a sudden we get a very different picture. Look at the
Mm,
PEG ratio of Walmart and Costco. They're near 4, right? Doesn't mean you shouldn't own them, but they're just trading very expensive because these companies are massive companies, they're staples, they just don't grow that fast. Take a look at Nvidia though, at a half, Broadcom at 0.63. Apple's still pretty expensive at a 252 on its earnings, because this is what I was saying. Apple's not growing their earnings all that fast as compared to Microsoft at a 128 on the peg. So, and take Eli Lilly at a 0.67, Meta at a 110. Netflix at a 104, Disney at a 130. These companies are growing earnings very, very quickly, which gives you a much better perspective about what the future is going to look like.
okay. So I think that's a really important factor for folks to keep in mind. Explains one of the reasons why a company like NVIDIA can just keep going up as long as the price to earnings growth ratio is still low. It's not necessarily a steamroller you want to stand in front of. Um,
But see, right there's a really interesting comment, Adam. Right? It's like, well, it explains why Nvidia can just keep going up because of this. But then when something like gold's going through the roof or silver's going through the roof, everybody says, oh, that's fine because we have this narrative of debasement or whatever it is, right? As investors, we need to understand that the same metrics apply across all asset classes,
right.
right?
Although what's interesting about the two you selected there is that they don't have any earnings, which makes it really, there is no price to earnings growth ratio that you can use there.
Right. So if you don't have any fundamentals to trade off of, what are you trading off of? Strictly speculation.
Yeah. Now, some people will say, well, look, Lance, I've got a fundamental argument that's, about the amount of dollars being printed or whatever,
That's
but
that,
let's not get into all that.
well,
But
I understand, but that's not fundamentals. That's narrative. And that's the whole point, right? So as
well,
investors,
I don't want to get
yeah,
trapped in this, but if somebody says, fixed asset relative to number of dollars goes up, price of asset should go up. Is a fundamental reason. That's not a story. Um, but let's not get trapped in this. Let's not
okay.
get trapped in
I'll,
this.
I'll leave you alone. I disagree heavily with you for a whole variety of historical reasons, but we'll leave that alone for a minute.
Okay, okay, okay.
But
It's
the
less I
point
just don't
is,
want I don't want everybody watching to get
I
stuck in it.
understand. I understand. Everybody, but see, this is actually my point. You actually just made my point extremely well. We can't let our emotions and our quote unquote our narratives dictate how we invest money.
Right.
So
And don't
again,
worry, because we're going to get there specifically with gold and silver in this discussion. So just know
well, I
I'm,
understand.
I'm
I
not ignoring
understand.
it.
Right, right. So no, and it's fine. But I'm just saying is that what we allow to happen, and this is the whole point of what we're saying, is that what we allow to happen when we're investing is that when an asset price goes up, we want to keep buying more of that, more of that, more of that. But we ignore the assets that are getting really cheap. Let me show you something that we just talked about you and I were on this show probably 2 months ago,
Yeah.
and we were talking about energy stocks, and we're talking about the issue of rotation within the markets.
Right.
And there, let me.
Okay. I've got that on the list here too. So
Yeah,
you're
yeah.
you're hitting all the highlights. And by the way, I agree 1,000% with what you just said, which is that certainly Western investors,
Mhm.
we have a very uh, habit that works against our interests, which is we generally don't start buying until we're chasing something. Because, oh,
Right,
look, it went up yesterday. It's going to go up more tomorrow, right?
right.
I think Eastern investors have been much better at saying, hey, I think this is a good asset. I'm going to wait until it goes on sale to buy. And if it goes lower, I'm going to buy more of it, right?
Sure.
Which obviously is the buy low, sell high success story.
Yeah, we just do
Uh,
such a terrible job of that because we allow our emotion to evade that. But here's the sector rotation chart that we
yeah,
talked about from time to time. about 2 months ago, you and I were talking, and energy was the most oversold sector. In fact, everybody hated energy. Nobody wanted to be in it at all. And that was when we actually launched the energy portfolio not too long after that. It was in kind of mid-November-ish, we launched the energy portfolio. It's now the most overbought sector. It's up here in the far right corner, right?
Wow, that was
So
pretty quick.
yeah, yeah. So these rotations within the markets happen all the time. So as an investor right now, just looking at this chart, if I was just looking at this chart right now, this table, where would I likely want to be taking money from, and where would I likely want to be putting money into?
Right.
And what are investors doing right now? Investors are chasing energy, right? Over, Iran and this and that. So I need to buy energy stocks. But in reality, maybe I should be thinking about healthcare, which was really, really overbought. It's now back to really oversold. Maybe I should be thinking about financials, which really got beat up here. So maybe there's some better areas in the market. I should be thinking about
Yeah.
not selling everything, but reducing my exposure to energy and materials, which are extremely overbought, and maybe buying some stuff that people don't think so much about right now.
So it's interesting. I want to talk to you about two things there. I'm going to mention them both just so you can help me remember them.
Sure.
So a lot of very successful investors say two things. You want to look for breakouts, right? There's a lot of institutional or professional investors who their whole career is just waiting for assets to make a breakout, right? To break above a long trend line and then
Right.
ride it, right? Trend is your friend until the end, right?
Right.
So how do you as a capital manager differentiate between, okay, this week this sector's getting the most love, right? So therefore maybe I
Mhm.
want to lighten up on it versus oils or energy is a great example. Hey, if it just made a breakout, do I actually want to lean into this thing because I might have months or quarters of riding the breakout?
Well, so two things are is, and again, when you have something break out of a base or a trend, whatever it is, that is very bullish. And so, but that happened a while back, right? That breakout happened in really late December, very early January. So you've now had this very kind of big move in energy stocks, which by the way, energy stocks have been trading very far ahead above their fundamentals anyway, because if you take a look at the price of oil versus where energy stocks were trading, there was a big gap, which
Hmm.
normally doesn't happen. But no, like for instance, we still have energy exposure in our portfolio. We're not going to get rid of that. But like this week, going into earnings, we reduced some of our technology stocks and started looking to buy more of the kind of some of the out of favor financials, defenses, those type of things. So,
Hmm.
it doesn't mean you have to necessarily sell your energy stocks to go do something else. Just be aware that these big extensions suggest two things. One, when you're three standard deviations above long-term moving averages, take some profits, right? Raise a little bit of cash, take some profits, put some money away, because when things correct, you can always buy stuff back. And this is always the fascinating thing to me about individuals. They say, well, I don't want to sell this asset because it could just keep going up. Well, yeah, take some profits. If it keeps going up, that's fantastic. You participate, but now you've got cash to buy it when it eventually corrects. So, that's just kind of the part of the process of managing money. Now, the difference between what you're talking about is if I'm a momentum investor, then yes, I want to buy breakouts. And I want to ride those breakouts as long as I can before they crash. Um, that's what momentum investing is. I'm a long-term capital growth investor, right? So I'm kind of more of the Warren Buffett type, analysis and investing. So I'm looking for things with good, strong fundamentals, really great moats, strong stories that I can own for 20, 30, 40 years. And that's why I love companies like AbbVie and Eli Lilly and some of these other companies that we own in our portfolio because they have huge moats. Nobody's that they've got the Nvidia is another good example. Huge moat has an ability to really kind of dictate their marketplace, massive market share, um, great earnings growth, and those are companies that probably are going to still be in the leadership position 5 years from now, 10 years from now, 15 years from now. Those are the kind of companies I want to own.
Okay, so, and don't put words in your mouth here, but it sounds like you don't do too much momentum trading. The way you quote unquote play a breakout is the main decision is, do I have it in the portfolio or not? And then once you have it at a target weight, once it grows, if it's in a momentum phase, once it grows bigger than your target weight, you trim it back. But obviously, if it keeps going higher and
Mhm.
higher, you're riding that and you're trimming it back because you're taking gains along the way until the trend ends.
Yeah.
And then
And
if you decide that it enters into a bad trend, well, then just maybe you take it out of the portfolio.
yeah, yeah. And look, and energy is a really, really good example. So this is a very long, this chart goes back to 2003. So this is energy, this is XLE. So this is energy, this is the energy stock ETF. This isn't
Yeah.
oil prices. Now, if I overlay oil prices on this, they will almost track identically up until the last year, about the last 3 years. Energy prices declined and energy stocks did not. That's why I'm talking about this gap. Previous to about 2021, you could overlay oil prices to energy stocks and you couldn't tell the difference between which one was which. So this breakout of this correlation is very important because energy stocks get their revenues from the price of oil. So that's
Hmm.
your big fundamental driver. And there's a big gap between that right now. But you've had these breaks. So here was your peak back in 2008-ish for energy. And then you broke out of that very temporarily in 2014, 2015, gave it all back up. You're now coming back to tag here. So there's certainly some upside here. So this is a monthly chart now. We're only two standard deviations above the monthly moving averages. So there's definitely some upside to around 80, maybe even $90 a barrel in terms of oil. But the XLE should trade up there as well. But again, these breakouts to the upside in energy, they're very, very tied to economic activity, and higher oil prices slows economic activity. So I'm much less, as a momentum investor, this breakout is fine. You just need to understand that high prices in energy are going to translate back to slower economic growth, which brings down the price of oil. So these breakouts don't tend to last for very long. So make sure you take advantage of it and navigate that accordingly.
All right. And what's so funny too, just to your point about don't get caught up in narrative, move your cursor there. Okay. So, you're seeing this breakout go on here, that big green candle.
Mhm,
That happened basically right after everybody said, "Oh, we just went into Venezuela. There's going to be a ton of new oil
mhm.
on the scene. Oil prices are definitely going to be struggling from here." But of course, the energy stocks are saying, "Hey, we think a different story here."
Yeah.
So a lot of people that bought into that headline narrative are now saying, "Whoa, wait a second, I just missed this boat."
Yeah, well, again, it's early. This move is early. We're about to trigger a monthly buy signal. So again, there's some decent upside from here. I'm not going to speculate where upside is. And again, we're long energy stocks in our portfolio, but they are overbought near term. So, if some type of news headline comes out, in fact, there was one today. Iran is now willing to talk about, kind of,
Right.
what's going on between the US and them. They want to see the terms of the negotiation, those type of things. But that kind of de-escalation will potentially lower oil prices, right? Oil prices have been running up on kind of these geopolitical tensions. So if those geopolitical tensions reverse, you're going to get, a pullback in energy stocks. They get oversold again. Then you have a really good opportunity to buy back in and add into those positions, which, again, as an investor, our job is not to buy stuff at the peak. I want to try to buy stuff where I get a little bit better value for my money.
Yeah.
Yeah.
So Lance, I see in the comments week after week that when people get frustrated with you, it's usually because you're kind of pouring cold water on something they feel passionately about.
Exactly.
And I just want to remind folks like this is what a good advisor is supposed to do is to be unsexy, right?
Right.
To not get caught up in something, to say, well, no, this sector might be taking off, but I'm gonna, make sure go back, I trim back to my original position size, and I'm not going to get totally caught up in this. I'm not going to lean super hard into this. Um, it can sound frustratingly dull,
Right.
but that is how you avoid making big mistakes. And as you said many times, Lance, growing wealth is almost more about minimizing your mistakes than it is maximizing your home runs, right?
Yeah. And look, and again, it's just, what my whole job is just to ensure that, capital that our clients don't suffer big capital destruction. Making gains is easy, right? So as long as markets are going up, it's easier to invest capital and make money, which is great. That's what we're supposed to do. And it doesn't matter what asset class you invest in. If it's going up and you're making money, that's fantastic. But just understand that everything has mean reversions are never going to be taken out of the market, right? This time is never different. You're going to have a mean reversion. So just don't forget to manage the risk.
Yeah. All right. And then the second thing I wanted to mention was uh, I don't know if you remember the videos the interviews I've done with Chris Brightman, who's the I think, chief investment
Yeah, Chris
officer
Well. Yeah.
of Research Associates.
Yeah. Great
Um,
guy.
Great guy, super smart. Research Associates super influential because there's just gazillions of billions of dollars that are managed based upon Research Associates' research. Um, and so when I talk to Chris, he's happy to talk about what the markets are doing, but he has shared his formula for becoming wealthy in life, financially wealthy, and it's a very simple one. I think you'd agree with, where he's like, can't remember the exact formula. So folks, if you're interested, go search for Chris Brightman on this YouTube channel. But he basically says, once you start making money, um, you know, take whatever you can put away every month and put it into the kind of this basic portfolio. And I think it's sort of like 8 different sectors. It's like U.S. growth, international growth, or sorry, U.S. stocks, international stocks, same things with bonds, a few other categories, nothing super sexy again. Um, so he said, equally fund them all initially, and then every month your contribution should go into whichever one is down the most over the previous month,
Yep.
right? And you just keep doing that until you're basically 50 or
Yep.
retire, and then you just start withdrawing, the opposite way around. Which one was up the most? Okay, I'm going to withdraw from that
Yep.
this month and just write it down. He's like, if you do that, you're going to be, you're going to have multi-millions of dollars, or probably looking forward from here, tens of millions of dollars, given what's happening with our currency over time. But you're going to beat inflation. You're going to make a ton of money, and you're not going to have to think more than 5 minutes a month about this.
No, it's absolutely right. But that's
Right.
just the basis of contrarian investing. And, it's been proven to work over time. But again, it's boring. It's interesting. I just had this conversation.
Boring and simple, but works, right?
Yeah,
But
yeah.
few
Well, no,
people
and
do it, right?
I just had the same conversation. So I've got one of my high net worth clients that I work with. Um, does a lot of private investing, private placements, those type of things. And, you run into a lot of issues with those in terms of liquidity risk and, capital risk and those type of things. But you can generate, if you do this right, you can generate 18, 20, 22% a year, which he's been doing for years. So he's done extremely well for himself. And so we were having a meeting this past week and we were just talking about it. And he's like, I'm spending all my time, working and researching. I do all this work on these investments and I'm making great returns with it. But man, it just absorbs all my time. I said, well, look, I said, you've got so much money in the bank. If you do nothing for the rest of your life, you'll never run out of money. And I said, but you still want to make, you still want to make money. So, if I can build you a portfolio that generates 10 or 12% a year with very little volatility risk and basically no real liquidity risk of, so to speak, would you be willing to give up, the differential between 16, 18 or 20? He's like, yeah, in a minute. I said, well, that can be done. And, so when you start, kind of putting things in perspective about what's important versus the game of just chasing returns, it becomes a very different analysis. And again, we're so tied up into chasing what's hot. It's like, oh, I'm invested in this, and it's just every day it just goes up, and it's so much fun. It's like going to Vegas and just keep betting on black, and it keeps coming up black every time, and it's like, oh, this is great, I can't lose. Just realize that someday it comes up red, and the issue that becomes then is how do you get yourself out of that trap? So planning ahead and those type of things is important, but trying to curb that speculative emotion is the hardest thing we have to do as investors. And always try to ask clients, I go, what's enough? Right? There's I kind of use this old analogy, and I said, if I give you a Mercedes for Christmas, you're really happy because I gave you a brand new Mercedes, but you found out that I gave, your best friend two Mercedes. Now you're upset because you didn't get as much as him, right? And as investors, we have to learn, what's enough, right? I need to stop worrying about what my neighbor's doing or what this is doing or who's doing that over there and just focus on what's enough for me. How do I sleep at night? And as long as I can control my risk outcomes, I can survive the long game. And that's all this comes down to is just making sure that we survive the long game. Talk to people in 1998, 1999, they had the tiger by the tail. It was great. If they were ready to retire, they didn't because of what happened in the dot-com crisis. Same thing happened to people in 2007. People ready to retire in 2007 couldn't because of what happened in 2008.
Right.
So when we get into the next downturn, whenever that is, there's a lot of people right now that are running around like, oh man, I'm making money hand over fist. and they're going to wind up giving up the vast majority of that, destroying their retirements because they're taking on too much speculation.
Yeah. Um, it all comes back down to just, being smart and not sexy and dull. And we
Investing is supposed to be boring. This should be the most boring show on the planet. Every week we talk about, yep, we bought value stocks and they did nothing this week but throw off a dividend. That would be awesome.
Right, right. But well, we've casinoized the markets, and we've certainly, as you've
Yeah.
talked about in the past, really encouraged people to act more like speculators than investors. Um, and don't get me wrong, folks. Making money is I really
Fun.
like it. That's sexy to me.
Yeah, yeah,
But to me, it's sexy to do it with good risk management. And I just want to note too, we talked about this in a rant, so I won't go deep into it. But you remember the story about Patrick Berry,
yeah.
the NBA guy with the highest uh, free throw percentage in terms of
Yep.
making his free throws, and he was the only guy in the league who shot the granny shot, the underhand granny shot, right? Looked super lame, but the physics were more favorable to actually making your shots more consistently, right? And he dominated, that category. And I told the story about Wilt Chamberlain and how Wilt was a terrible free throw shooter. And actually, Patrick Berry helped him, basically learn to shoot granny. And he did for a season or two. And one of those seasons was when he had the famous 100-point game, right?
Mhm.
Because he made like 80 something percent of his free throws that game because he was shooting underhanded. And then Wilt stopped after a while, and his free throw percentage plummeted. And in his memoirs, he basically said like, "Yeah, it was a mistake to change. I just felt like a sissy. Like I just, and that's a great example.
Ego,
His emotions got in the way, right?" And
ego.
I bring that up because there was just a discussion on sports media this week about same thing with Shaq, where if Shaq had listened to Patrick Berry, he would have had a much better stats. He would have had more game time. He would have made more money. His team would have done better. And granted, Shaq was a great player, just like Wilt Chamberlain. But when you're a crappy free throw
Mm.
shooter, they called it the Shaq attack. You deliberately start fouling the guy in the last couple of minutes of the game because you hope to get the ball back, right? So
Right.
again, sometimes the unsexiest thing is the best thing to do for your long-term prospects. But as you said, our brains get in the way. Okay, let me get back to the hyperscalers for a second, or at least the big tech. So you mentioned that Apple is actually not bucking the trend. It's going up while like say Microsoft's going down. And I haven't read beyond the headlines on this, Lance.
Mm.
But apparently, what surprised people on Apple's recent earnings call was a surge in demand from China.
Right.
And I'm hearing a lot of people sort of say that's kind of fishy. Like, what's the reason why all of a sudden people in China would basically get dramatically more interested in buying a phone they're extremely familiar with when there's all sorts of domestic competitors that do a whole bunch of things that the iPhone doesn't even do.
Cheaper
Um,
dollar.
is that it? Is it just the exchange
It's a
rate?
big reason. I mean, look, you travel to any other country, and look, I spent 15 years of my life living out of the US. I was back and forth, but predominantly I was out of the country. And you go to every other country in the world and talk to anybody, and all they want is American products, right? Music, jeans, whatever it is. If they can get something from America, that's like the coolest thing ever. Um, so, if the dollar gets weak enough, and we've had, the dollar down about 10% last year, that currency exchange rate, now I can buy an iPhone cheaper than I can buy a domestic phone. So now I get to have the coolest new phone on the planet. So, why not buy it? So again, a lot of it has to do with just, kind of economics. But, again, I have no way to validate or to invalidate their claims about China's sales. I'm just saying the decline of the dollar makes a lot of sense.
Okay, so an exchange rate differential could explain
Right.
that. All right,
And
so
that's and
I was
look,
just
and that's
basically
and that's
asking if there was any fire to that smoke that you knew of, but it
Oh,
sounds like
it's there's always smoke. Everybody's a hater. At the end of the day, if they don't like Apple, there's always a reason to hate why Apple's doing well. I just buy the stock because it was very cheap going into earnings. Earnings were good. I think I'm going to get a bounce out of it in the next few weeks, and I may sell it and take my money and run away. So for me, it just doesn't matter. But what I find interesting is that this is why President Trump wants a weaker dollar, specifically for this reason is that a weaker dollar improves exports for the US, right? Because again, we export a lot of goods, and when the dollar's weaker relative to other currencies, that is good for US companies. So the weaker dollar is going to play into profit margins, play into earnings, those type of things as well. So that's why Trump, everybody's like, I don't know why Trump wants a weaker dollar. It's very good for US exports.
right, right. And Trump wants more people in America to buy American, so it makes American
Yeah,
products
makes
domestically
American
look more
products cheaper.
attractive versus
Yeah,
imports. Okay, so Lance, at the conference, your recent conference there in Houston, you kind of gave, well, you didn't kind of, you gave a presentation that was both putting on your bull hat and your bear hat.
right.
And not saying that you were rooting for one particular pathway, but you were just sort of saying, hey, I'm gonna be my own debate society. I'm gonna make the bull case, and then I'm gonna make the bear case. Do you want to do a condensed version of that for the audience here?
Yeah, we can. And actually, I'm just writing a whole series of articles kind of on the same narrative over the next, really, I had one out last Friday, had one out yesterday,
Right.
or actually today, sorry, came out on this Friday. But just kind of looking at this quote unquote, this reflation narrative. So if you take a look, and I can show you a few charts here just as a good example. If you take a look at what's going on right now with kind of Wall Street in general, they are very optimistic about earnings for this year. So this is actually a chart from that presentation, but this is the earnings expectation for growth this year. Now, what I want you to note about this first chart on the left is this is the S&P 500 consensus earnings growth going back to 2022. And the light blue bars are expected, and the dots are actual. Now, what's interesting about this is that current expectations are well above what's happened over the last 4 years. Now, why is that important? Is that earnings growth, our economic growth this year is expected to slow down towards about 2%, but we're expecting higher earnings growth than we had in previous years where we had much stronger economic growth. We had much stronger economic growth in 2022, 3, and 4 because of all that stimulus that we slammed into the economy. So nominal growth was very high, but yet you didn't generate that much in earnings growth. Same thing where we are now. You've got the economy slowing down. You don't really have that stimulus flow through, but you're expecting much stronger rates of earnings growth. So this is kind of the setup for this year going in. This is whole idea is based on this economic reflation. And year-over-year earnings growth, if you take a look at the top, the Magnificent Seven is still expected to grow between, 22 and 25% this year. But we're expecting the bottom end of bottom 493 to start generating much higher earnings growth this year than what they generated over the past 2 years. So again, there's seems to be a little bit of a disconnect considering that earnings growth comes from economic growth. Seems to be a little bit of a disconnect on expectations, but this is and quarterly profit margins are expected to massively surge. So this is supposedly from AI. AI is going to massively increase productivity. It's going to lead to a much bigger expansion of profit margins. Not sure that's a great thing because that's going to come at the expense of employment. But we'll see how this all works out. So this whole reflation narrative is kind of important to the markets. But again, this all goes back to confirmation bias. And, if you take a look historically with the markets, there's always a reason why the market's going up or when the market's going down, whatever it is. There's some narrative kind of behind that. And that's why, you always want to be careful with narratives. This is doing that because of this reason.
Right. Hey, Lance, sorry to interrupt. Can you expand the slide here?
Sure.
Yeah.
But yeah, so just be careful about these narratives because narratives are just rationalization. Why is silver going up as much as it has been? Well, it's the debasement argument. Well, there's a lot of faults with that argument. We've been through that before. But though that's the rationalization. I need to rationalize that. Why are AI stocks declining? Well, it has nothing to do with the fact that they were really overbought from last year, and you're just going through a little bit of a corrective cycle, which happens all the time. But it's, oh well, AI now, the narrative is it's crashing because of, whatever, nobody wants AI in the future. Well, we all know that's horse hockey, and that AI is going to be a major push over the course of the next 5 years in particular, for the country. So, being out of AI stocks when that's your next industrial boom is kind of nonsensical, but that's where a lot of investors are going to get left on the sidelines. So the real point here is to be very, very careful with narratives, because they get you off sides of what's actually going on in the markets. And right now, that narrative is reflation is going to be a very, very big deal this year. So the risk to this, and this is what we were talking about at the conference, is that the reflation narrative is that we're going to have economic growth with no inflation. The problem is that inflation is linked to economic growth, because that's economic growth creates demand in the economy. Demand creates a differential between the demand and the supply being put out that lifts prices, which
Yeah.
that is going to lead to inflation.
So
So,
sorry, two things.
but
One, can you expand the chart again here? And
sure,
then
sure.
two, um, uh, it is I get what you're saying there about economic growth,
Mhm.
can lead to higher inflation. Is it concurrent or is there a lag? In other words,
Oh,
could you
there's a
get the
lag.
growth in 2026, but not the inflationary impact until 2027?
Well, so two things. First of all, is that we're talking about inflation in specific areas of the economy. So in other words, the problem with CPI has the reason everybody was expecting CPI to go surging off to the moon. What everybody missed with that, and the reason we haven't had inflation, is because 40% of that index is housing,
Right. And shelter
right?
is disinflating or even deflating right now
Correct. And
across the
that's
country.
and so it doesn't matter what happens in energy, because you have such a massive component of CPI dragging down the whole index. Doesn't mean there's not inflation in the economy. It just means it's not being represented in CPI because of that one component. Now, from an investment standpoint, I don't care about the other stuff. All I care about is what CPI does, because that's what the market trades off of. So again, we can argue all day about inflation in the economy. I don't care really about that narrative, because what the market's going to trade off of is what's that CPI print and what does that mean for the Fed. So as an investor, that's all you need to care about. Don't worry about the other stuff.
Mhm.
But again, when you start getting an economic flow through of more demand, and again, just take a look at energy prices. If oil prices go to 90, it's going to show up in inflation in 3 to 4 months, right? But there's
Okay.
about a 3 month lag of oil prices getting into CPI, but there's a very high correlation between energy prices and CPI.
Right.
So again,
But
those inflationary
part of why I'm
inputs are going
asking
to
this
feed
is just if they can goose economic growth in the
in. Mhm.
next 4 or 5 months,
Yep.
but the inflationary part doesn't arrive until after the midterms, that could be a factor here. Obviously, if inflation arrives before the midterms, bad for the
Right.
administration.
But if
Yeah.
inflation goes up and profit and if inflation rises and corporations can't pass that inflation to consumers, that
Hmm.
eats into profit margins. So that whole profit margin story. So let's just go back to the reflation narrative. I'm just talking about the risk to the narrative. The narrative
Yep.
is that we're gonna have this massive expansion of earnings and massive expansion of profitability this year, because we're gonna have economic growth and no inflation. All I'm saying is there's a risk to that view, and that earnings may not be as strong this year because of other stuff that's going on. So this is kind of the Fed funds rate. So the other aspect of the reflation narrative is that we have this resurgence of economic growth with no inflation, which also allows the Fed to continue cutting rates. Well, we just had the Fed hold pat now because of stable economic growth, and not a lot of economic growth is good, and employment is stable. So the Fed's going to be on pause. But again, if you start seeing inflation pass through to the economy, the Fed can't cut rates. So that here's another leg of that stool that begins to cut out from underneath the market, that these kind of elevated expectations are built on, which is a lower discount rate to justify higher valuations,
Hmm.
right? So again, this is CapEx estimates for this year, and again, we're good. And look, this is right now. This is all getting confirmed. Microsoft's increasing CapEx, Meta's increasing CapEx, everybody's increasing CapEx for this year. So we may see this CapEx push through. But the issue with that is that yes, that's going to provide some economic support, but CapEx as a function of the entire economy is not that large. So you're going to get some economic growth out of that, but it's not going to be in 1 year. It's not going to move the needle dramatically higher to potentially offset the risk of, again, if I have this CapEx coming in, which creates stronger growth, I'm putting more demand on the supply chain for products, goods, and service to build out data centers and whatever else I'm doing with CapEx. That's going to put pressure on inflation. Inflation is going to weigh on the Fed. And so you kind of start to see the snowball effect that occurs,
Yep.
right? And so that's really kind of the crux of what I'm worried about this year is that from an investment management standpoint, nobody's concerned about the downside risk. Everything is roses right now, but there seems to me at least there seems to be some risk to that narrative that we come in with a much lower rate of realistic earnings growth than what's currently expected, and that weighs on valuations when you have valuations at current levels.
Okay. And there's sort of two elements that I just want to flag for folks. One is what I hear sort of you saying, Lance, which is we don't need to have so one risk is the economy, you know, uh, grows slower than expected,
Mhm.
or CapEx comes in a lot less than people thought, and the AI trade implodes or whatever, right? Like there's downside surprises that could happen in here, right? But I think what
Mhm.
you're saying is just we have a market that is largely kind of priced for perfection,
Yep.
right? And so it's sort of the Microsoft scenario, which is, you know, the wheels don't have to come off. Microsoft doesn't have to go off the rails. It just has to be a little bit less than perfection for the
Right.
stock to get walloped. And so the market could be similar, right? Where it's like, hey, we could still see profit growth or earnings growth in, you know, all these other companies that we're expecting tremendous earning growth in. But if it's not tremendous earning growth, if it's just good earnings growth, that could still whack valuations materially.
That's right.
Yeah.
And again, that's the big concern is that if the market was trading at 15 times earnings or 18 times earnings, it's a different story. When you're trading at 22, 23, 24 times earnings, that's your risk because valuations in the short term are just a function of investor psychology. And right now, investors are willing to overpay for asset prices just because they're going up.
Right.
And again, this goes back to the fundamental narratives and fundamental valuations and those type of things. So again, trying to sort through the markets and find out where opportunities exist longer term is becoming much more difficult. And so part of the trade right now remains on the momentum side, but there's, what's going to matter long term is when the market comes to the realization that earnings aren't growing as expected for the bottom 493 or the top seven or whoever it is, that there's going to be a repricing of valuations. And so you want to make sure you're on the right side of that repricing when it occurs.
Okay. And I would say listen to that, folks. You know, you've got a sort of self-described Buffett-esque capital allocator here, meaning you're looking to buy companies that you're hoping to hold for a long time.
Mhm.
You're doing it in the unsexy way that we were talking about earlier. And you're saying with that approach, it's getting harder and harder to find companies to buy,
Right.
right? Yeah.
Now, and again, look, it also, again, while we buy companies based on fundamentals, we do have some stocks in our portfolio that are strictly momentum trades, because we need to create returns for clients over time. And when you're in a momentum-driven market, you need to participate in a momentum-driven market. So, I'm not running a Buffett portfolio type where I'm only buying companies at, deep discounts to cash values, those type of things. We own those types of companies, but we also own growth companies as well. But I try to keep the portfolio tilted more towards value and fundamentals than the growth and momentum side of the equation.
Okay. All right. I was about to switch topics here, but actually, just so we don't forget to do it, can you pull up the current S&P and just show us where we are technically right now?
So this is the S&P. This kind of orange triangle right here. This was this kind of rising wedge that we were building in the markets, kind of going back to November. And kind of coming off that April low, we rallied up to all-time highs, and then in November we kind of began this correctional process in November. And this was the beginning of the AI trade, problem narrative, et cetera. Then the markets rallied back and we kind of stair stepped higher kind of building this kind of rising bullish trend line, reached all-time highs. Actually, this week we touched 7,000 this week. Um, and then from that, the market's kind of trailed off. So last 3 days, and so we're recording on Friday. We're about 11 a.m. on a Friday morning Central Time. Markets are sitting right on the 20-day moving average right now. So that's been really good support for the markets here, going back kind of all the way back to April in particular. There is risk to the downside down to the 50-day, which was kind of what occurred with that sell-off yesterday. We had a
Right.
big sell-off yesterday morning because of the Microsoft news, and then recovered all of that by the afternoon.
Mhm.
Market ended about flat yesterday.
An interesting, sorry to interrupt there, but like
Good.
everything sold off for a minute.
Mhm.
So was it triggered by Microsoft? Because I mean, like copper was down. Obviously, the precious metals were big down. Um, Bitcoin was down. I mean, it wasn't just limited to
Right.
one stock or one
No,
index.
well, no, but this is what I've told you before, is that when all assets are correlated to one, it doesn't take much. It just takes a piece of news. Kevin Warsh is going to be the next, Fed president, which was
Right.
announced this morning.
Which we're going to talk about in a minute, but yeah.
Sure. But when all assets are correlated to one, you're going to get hit in every asset class that's correlated to one. Because when the algorithms sell, they're going to sell everything. They're not going to selectively sell, Microsoft and not sell the entire market. They're not going to sell the market and not sell copper and gold and silver when all those are correlated to one and all of them are extremely overbought. So that was just a de-risking move yesterday. And so when you get into these de-risking moves and you have high asset classes all correlated to one, there's no safe place to hide.
Hmm.
So just that's just part of investing and that's part of volatility. And that's why it's important to make sure that you're not overly allocated to a series of assets that are all tied at the hip in terms of being their correlations are near one.
Okay. Um, all right. And then, sorry, I know I interrupted you here, but how concerned are you? I know it recovered within the day yesterday, but how concerned are you that the recent price action is all below that rising
No,
wedge you have there?
No, that is certainly a concern right now. Technically, you broke this downtrend line. You fell, you rallied back to it. So on Wednesday, I gotta get my day straight. On Wednesday, you rallied to it and actually got above that rising trend line, but closed below it again. And technically, you fell at it yesterday. And so we're sitting on the 20-day moving average. So what's important right now is that either the market is going to break lower here and probably retest either the 50 or the 100-day moving average, which is entirely possible. We're going into February. February tends to be a weaker trading month anyway. It has about a 50-50 chance of being positive from one year to the next. So the statistical bias for February is not great. But you really haven't broken the back of the bullish narrative. And, so again, we've only kind of tripped back down here to the 20-day moving average. If the market can hold here and break out to all-time highs, nothing to worry about. If we do break lower below that 20-day moving average, we may have some more work to do here near term. We're not coming off extremely overbought levels, which is a positive. We've got momentum, not really overbought or stretched, and we're kind of sitting right on a buy, we're on a buy kind of slash sell right now. It's a very neutral indicator momentum wise. So there's definitely some weakness here that the market's been consolidating through. And we've just really been in this big consolidation channel now. If I could really draw this almost as a rectangle and just say we've not gone anywhere in the past, kind of 3 months. So kind of where the market goes next is going to be important. Do we break out to the upside and head up towards 7,100, or are we going to have a bigger correction between now and summer? Entirely possible, get a 5 or a 10% correction here that works off some, and again, we might see that across maybe all asset classes at once. Maybe we see, the market just kind of reset itself. Metals go down, stocks go down, whatever else, emerging markets and small caps and mid caps, they all kind of get hit at the same time. And you just kind of get this risk off move in the markets that resets the markets 5 or 10% lower and gives you a much better entry point to put money to work. Because the one thing is we haven't killed the bullish narrative, right? And we haven't killed the retail speculator at all. Retail speculation. I was posting this yesterday. If you take a look at retail speculation, so it was a very interesting chart from Citadel Securities. Um, Citadel is, if you don't know who Citadel is, Citadel Securities is a massive, massive hedge fund. And the reason that they're important to this analysis of retail investors is that Citadel basically pays for the order flow from Robinhood, which is where all your retail investors are. So everybody that trades on Robinhood, their orders get sent to Citadel, who can then basically trade ahead of you and then execute the trades for you. So free trading is never free, right? There's always an expense to
Yeah.
free trading. But right now, retail investors are at the 99% risk on level. You have not broken that at all. And so any pullback here, like for instance, silver's down, as we're talking right now, is down 15, 16% today, whatever. You're likely going to see retail investors go running right back into it because it just ran up. And this correction is like, oh, this is my dip. I got to buy it.
Yeah.
So that buy the dip mentality has been very much alive and well over the last couple of years. And I don't think that's changed yet.
Okay. By the way, silver's down 22% on the day that we're talking, but yes.
Okay.
Yeah.
Well, I haven't looked at it the last 5 minutes. So
Yeah. Well, it's continuing to drop as I've been
yeah.
checking it while we've been talking here.
Yeah.
Okay. All right. So that's the market. But I mean, so one could say we're sort of at a key moment in the market where it's going to decide
Mhm.
whether it's, this wedge it's broken down out of is going to be resistance, and then maybe we have this risk off reset that you talked about, or whether it punches through and we go on to new all-time highs.
Yeah.
All right.
And trust me, I would love a 5 to 10% correction. I've got capital I can put to work. So
And you've got companies in your buy list you'd love to buy
yeah,
at the right.
absolutely.
Yeah.
Absolutely. Like we were just talking about with the rotation, man, healthcare, financials, utilities, they're cheap right now.
Okay.
And they're over
Uh,
and nobody wants them.
I've got other topics I got to get through, but if you can, just give literally 30 seconds to United Healthcare, because I saw when it got whacked, some people be like, "Isn't this a company that Lance was really bullish on?"
I'm not long United Healthcare. I've got no play in it. My healthcare stocks are AbbVie and Eli Lilly in particular, for a variety of different reasons. But those companies are in very specific areas of healthcare that have a lot of longevity to them because of the changing demographic of the US, and we're becoming much more vain about our looks. So AbbVie, which is the maker of Botox, and Eli Lilly, which is the maker of GLP-1s, weight loss, and facelifts. So, they fit right in there in that. So I love those two companies, plus they pay good dividends. Um, but no, United Healthcare is one of those companies that they're going to be at some point here they're going to be a great buy. We're not getting any younger. People are demanding more and more from healthcare. And the only reason United Healthcare took a whack this week was because the U.S. government did not change. The markets were expecting that the Medicare subsidies to United Healthcare and the other providers of healthcare was going to go up by 7% this year, as they normally do. They held them at the same rate as last year. So there's going to be no inflation in healthcare costs from the Medicare payment side of the ledger, which is going to be an impact to their revenue. So United Healthcare, CVS, which is Aetna insurance, CVS bought Aetna a while back. That's a big blow to the amount of money that they make from the Medicare payments.
Okay.
So, but at some point, that's going to get worked out. And these stocks trade fairly cheaply. And again, I wouldn't buy them here. There's still more to work through. And these stocks have a history of having big declines and then really big runs. So, you got to really time your entry point. And at some point, maybe we'll look at them. But right now, just I'm leaving them alone for now.
Okay. All right. Well, look, let's get to the Fed. Two big bits of Fed news this week. One was we had an FOMC release, followed by Jerome Powell's press conference. So Lance, I'd love to get a sense if you took anything from that. I mean, there were few surprises in that discussion. It was pretty much what everybody expected. Fed pretty much left everything alone.
Mhm.
And then, as you just mentioned, we just got the news today that Kevin Warsh has been selected. And part of me wonders if that's one of the reasons why the precious metals are getting whacked right now is simply
Mhm.
because
Absolutely.
Warsh is more hawkish. He's not kind of known as a guy uh, to be to lean dovish, which is I think surprising a lot of people that Trump picked him because the narrative to date has been Trump's going to pick a total patsy. Of all the candidates, and I didn't know them all super well, but from the people I know who do know these candidates well, War seemed to me to be the one to least fit the mold of a patsy. So
Yeah.
maybe that's a reason why they're selling off.
Well, no, it is. Warsh is definitely more hawkish in theory.
Yeah.
than Hassett was, and even Rick Reeder was from BlackRock was the other contender. And I like Rick Reeder, but the problem with Rick Reeder is he's from BlackRock, which just embeds BlackRock with the government even more, which I already have
Right.
a problem with anyway after the 2020 issue. Um, but no, I mean, look, the reality is that Kevin Warsh at the end of the day is no different than any other Fed chairman, in my opinion. In 2008, he was right on board with doing QE. Whenever the banks have been in trouble, he's been right on board with basically to bail out the banks. So yeah, in theory, he may kind of dissent right now against, cutting rates, et cetera. But at the end of the day, if something goes wrong, he's going to be right in there doing QE and everything else. So, and remember, everybody thought Jerome Powell was going to be different when
Right.
we first elected Jerome Powell. It was like, oh, he's a different animal. He understands markets, and he was exactly the same as Yellen and Bernanke. So, at the end of the day, the banks control the Fed, and so whatever the banks need, the banks will get. And I just think that's important to remember. But I find Trump's nomination of Warsh very interesting. And yes, this is part of the reason that metals and kind of the entire narrative is getting hit today is because Warsh is not the guy, in theory. If I wanted, Trump's been saying I want interest rates to 1%. Warsh isn't that guy.
I was going to say he does not seem to be that guy.
Yeah,
Yeah.
and so it's interesting from the stand. So I find the nomination interesting, and I think he'll pass. I think he'll fly through Senate on getting passed. So I think that's not a problem. But I do find it interesting because Trump nominated the one guy who probably least agrees with what Trump wants, which is lower interest rates. And so again, this kind of feeds back into my reflation narrative story and about Fed policy. If economic growth is strong, I think you're going to get more pushback from Warsh about cutting rates. And again, that's what is weighing on the metals and the markets in general right now is this all of a sudden I've got to reprice this idea of easier monetary accommodation. That's why companies like Rocket Mortgage are down like 14-15% today, because now maybe we don't get, mortgage-backed security buying by the Fed, and we don't get the Fed back into mortgage-backed securities in terms of QE. Maybe we don't get lower rates, which is going to impact the mortgage rate. And so companies like Rocket come under pressure from that.
Hmm. Do you want to tell your story about your perfect contrarian indicator investor?
Yes. Um, this and look, we manage money for over 2,000 families. We have roughly about $2 billion under management, give or take. And so I have a lot of inputs from people that are investing in the markets. And you talk about sample sizes and statistics and those type of things. So it's always interesting when we start getting a lot of phone calls or emails or whatever it is from our clients wanting this asset or that asset. It's almost always a fantastic contrarian indicator of what's going on. And so I just had a call just recently from a client. He's like, sell off my tech stocks. I want to be long home builders and mortgage rates because of what the government's going to do with start, with this, buying mortgage-backed securities and helping support the housing market. And I'm like, that's a terrible idea, but I have to do it. So we complied with the request, of course. But it's interesting because this issue of Warsh, and again, he had no idea about Warsh coming up. It was just what Trump said about
Right.
buying mortgage-backed securities. But as is always the case with market narratives, it doesn't take much. It just takes a catalyst to reverse that trade. And Rocket Mortgage is a good example of this, had been running up in expectation of easier monetary accommodation, mortgage buyback securities, and all that. And this nomination of Kevin Morse potentially, not necessarily, changes all that. So what's happening in the markets right now is that markets are simply having to reprice those expectations. And the buyers are saying, and again, as we talked about before about buying and selling dynamics, and this is in
Right.
every market, doesn't matter what the market is, that when prices are going up, sellers are in control of a rising market because they can go, yeah, I'll sell you my shares of silver, gold, stocks, Nvidia, whatever, but you're going to have to pay me this price for it. So the buyer says, okay, I'll pay you for that. But as price rises, the number of buyers willing to buy at those higher levels is being reduced. It's all, think about like a pyramid. So as you go up, you get less buyers, fewer sellers, but it's at higher prices, and it's creating a supply demand imbalance. But when it reverses, those buyers are there and sellers go, okay, I got to get out. I need to sell now. And the buyer's like, yeah, I'm way down here, but I'll buy
Hmm.
from you. And sellers have, and this is what you're seeing in the markets today, is like in Rocket Mortgage is a good example. There's buyers for Rocket Mortgage today. They're 15% lower than where they were yesterday.
Right, right. Which of course is, precious metals investors are learning that in real time, right as
Yeah,
we're speaking here, Lance. And I'm going to get to that topic in just a second.
sure.
Two other ones, though, real quick. Actually, sorry, before we hop off the Fed. So one thing that caught my attention there is, again, folks are going to get tired of me doing this, but I keep raising the question of could economic growth surprise to the upside this year, right? Which of course is what
Mhm.
the administration is telling us to expect. Um, Powell said in his statements, and the FOMC had in their release, um, that the upside risks to inflation and the downside risks to employment have moderated.
Mhm.
And so they're basically saying, hey, we're finding ourselves less worried about both of our mandates. And so that's a big reason why we can just stand pat here right now
Right.
and keep rates where they are. Um, the Fed has access to more data than most of us do here. So to me, that is just a validating sign. It's not proof, but it's just a sign you would expect to see if the economy was actually starting to become healthier, right? Is you would see them worry less about inflation and worry less about unemployment, which is what they said. So I'm just noting it. All right.
Yeah, yeah.
Yeah.
And no, look, the assessment's right. I mean, but the problem for the Fed is always this. They work on lagging data,
Right. Oh,
right?
and
So
sorry, and they
there
also
is,
said that the economy looked like it was strengthening too.
right.
So it was sort of the trifecta. Yeah.
Right, right. So again, this is this that there in that story you just laid out. That is the reflation narrative.
Right.
Stronger economic growth, stable employment, no inflation. That's the soft landing reflation narrative, and that's what's driving everything right now in terms of expectations. But the Fed is always eventually wrong because they're working on lagging data, and
Right. Right.
they're always
And that's why I sort of just
yeah.
I'm saying it's not proof because their track record is pretty terrible what they do it.
Exactly. Exactly. But again, they're right. What they're saying is correct. But see, I don't think that's great for the markets because they're saying, hey, the market's okay. Sorry, they're saying the employment's okay. Inflation is pretty close to our target. We're not too worried about it. We think it's going to moderate down to two, which is really no reason to cut rates here, which is the whole narrative behind the market is lower rates and more monetary accommodation, and
Right.
that seems to be getting cut. But the Fed seems to be saying, "Hey, maybe not expect so much."
Right. And expectations are coming down. I mean, there's only
Yep.
two rate cuts, I think, planned for this year. But you're right. And that's the other thing that I'm trying to just put on people's radars as possible
Mhm.
is we could have a year where economic growth surprises to the upside, but the markets disappoint.
Right.
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 Everybody's so used to them being so tightly correlated, but they don't have to be, and they may not be this year.
Yeah, it's right. And again, what happens if two becomes, two rate cuts become zero,
Right.
right?
Yeah. I mean, that's going to need a repricing of
Right.
expectations.
Yeah, because of discount
Um,
rates. Yes.
okay. So I know what your answer is going to be to this question, but I'm going to ask it anyways because I know
Mhm.
people have the question. Um, we've been hearing more and more about the end of globalization. We just had Davos.
Mhm.
The again, the U.S. representatives there use those words. Globalization is over, right? We're seeing, Mark Carney and other key, longtime allies of ours saying, hey, it's a new world order, and we can't be as trusting of the U.S. as we used to. And we just had a massive trade deal announced between the EU and India, and to the extent that it can, the rest of the Western world, at least, is sort of trying to send a signal to America of, hey, we don't like you flexing your muscles, and you're going to force us to try to, you know, depend less on you, right? Now,
Mhm.
whether they will be able to or not in the long run, totally up for debate. But I know you kind of chuckled last week about some Danish sovereign fund, stopping its purchase of U.S. Treasuries, and you said like
Yeah.
RAA buys a lot more than they do.
Yeah.
Um,
I didn't
but
chuckle. I was just making a point.
yeah. Um, but my question now that we're seeing things like this big trade deal between the EU and India, um, you know, is there truly no impact, or are we starting to see any sort of at least near-term impact on demand for the American capital markets? And I'm trying to remember who I talked to recently. I want to say it was Axel Merck, but I could be wrong. But somebody I talked to this week, sort of brought up that, hey, we are starting to see them buy a little bit less of treasuries. And I was like, really? I thought the data had shown that that wasn't really being impacted. And they said, well, no, it's sort of starting to be. It's not necessarily a crisis, but I don't know if that's true or not. I haven't verified it. But I'm just for a guy like you who has generally shrugged this off to date, are you still shrugging it off, or are you paying a little more attention to
Yeah.
it?
No, I mean it's look, foreign demand for treasuries is about well actually been ticking up here over the last few treasury auctions. It's about where it normally trades historically. There's this chart that's running around everywhere. I think it's from Tavi Costa put it out, and it just shows China's ownership's U.S. Treasury versus their gold holdings. And it's a very deceptive chart because China buys a big chunk of their treasuries through Belgium, and the Belgium
Mhm.
holdings of treasuries is rising very sharply.
Yeah.
But
And
they
sorry to interrupt, but was that chart absolute numbers or was it percentages? Because obviously the
No,
gold holdings are going to go
it was
way up
ton
as a
right. No, that was showing tons of gold. He actually corrected that chart. He used to show the chart of the price, basically representing the price of gold versus treasuries, which was also a chart crime, and he got called out on that. So now he
yeah.
represents it's in ton, in, metric tons of gold ownership, which is the right way
Okay.
to do it
Yep,
versus
that
the
makes
value of the
sense.
bonds.
Yep.
So that's the right way to do it. But the problem is he doesn't include the holdings of Belgium treasuries,
Which is a
which China
proxy.
uses as a proxy to buy their treasuries with to balance their reserves. So anyway, treasury purchases are just fine. Alberta, I think, correct me, I may be wrong, but I believe it was Alberta, just had like hundreds of thousands of people or whatever standing in line in Canada to basically vote for secession from Canada to become part of the US. So there's, these narratives. Again, this is back to narratives, which is, I'm Europe. I'm gonna go do a trade deal with India. Great, go do it. You should have done it years ago. The EU economy grows at about half the rate of the US. But, great, go do your own trade deal with India. That's fantastic. That's great. You should have been doing it a long time ago. Europe has negated for decades their, economic prosperity by doing a lot of the stuff that they do. For instance, creating the EU was not a great economic revival that they all thought it was going to be. So, they need to be doing deals. Germany's in a terrible situation, economically from the policies that they've implemented really on themselves, from
Right.
power to a whole variety of other things. So all Trump is saying is like, look, we're going to start instead of us subsidizing the rest of the world, which we've been doing for decades, we're now going to start focusing more on us and making America stronger. And they don't like that, and that's completely understandable because it shifts that balance of trade power back to the
Yeah.
US.
Yeah. Everybody liked the status quo. So you change the status quo, they're going
Absolutely,
to be
because
happy. Yeah.
it was very beneficial for them, and they don't like that change. So this end of globalization for them, yeah, it's not great, but it's better for America long term if we can stick with it. And but again, the problem is we change administration, then whoever we get like next reverses everything, right? And so we
Right.
go back to where it was, status quo. And that's what I suspect is going to happen after this 4-year run is over. We'll elect somebody else, and then it'll be a reset back to kind of the way things were. But we'll see what happens. That's just a kind of a forward look. But yeah, again, though, but when we get on the ground and start talking about, what's happening, a lot of these narratives about, oh, nobody wants to own our treasuries. It's just not true. I mean, you take a look at the data, treasury ownership by foreign individuals are rising sharply. We talked about last week this idea that Europe's going to dump all their bonds. They can't. And it's also monetary suicide if they do, because at the end of the day, we're still the reserve currency, and that's not going to change anytime soon. As we talked about last week, you start using stable coins for transactions, that really only cements the US even further into the
Right.
reserve currency balance of the US, of the world.
Well, okay. All right.
So, but I'm not saying, but to your question,
Mhm.
we're certainly not ignoring it, right? We're paying attention to the data. We're just not seeing, kind of some of these end of the world narratives that are running around by people trying to make video headlines and those type of things like, oh, the world crash is coming. It's not showing up in the data.
Right.
We've
And
got
that's exactly why I'm asking the question,
yeah,
right? Yeah.
yeah, and economic growth in the U.S. is killing it. And one of the reasons that economic growth in the U.S. is killing it over the last couple of quarters is because of our net export issue, right? We've got too many exports, not enough imports. That's good for the U.S. So
Hmm.
we're seeing a lot of economic benefit from that. So you love it or hate it, right now, globalization seems to be working in our favor rather than against us.
Okay. In intellectual exercise that I think would be fun to go through with you at some point,
Sure,
not this week, but in a future one,
sure.
is let's really kind of play out the Monroe Doctrine
Okay.
2.0. Let's talk about what that world looks like. Um,
We're talking about
you
the
know,
Donroe Doctrine.
yeah, the Monroe Doctrine, right?
Yeah.
And you mentioned Alberta. Uh, we talked about this last week, and what I kind of took from the comments from Canadians was um, it's never going to happen, right? Yeah, it's getting a lot of headlines, but it's never going to happen, and it's a minority of people that are agitating for it, and Canada's too dependent on it and can't give it up, and just a whole bunch of other things.
Right. But they also
But it
said
was
that about Greenland, and now Denmark is at the table negotiating over Greenland.
Yeah,
So,
but nobody's depending upon resources from Greenland to power their economy
well,
today, right? Where Alberta,
but all I'm saying, yeah, and you're absolutely right, right? You're absolutely right. But what's important to take away from this is that narratives are great, but they change. And you're right. Nobody expects Alberta to become a
yeah. Well, don't
50%,
don't
right?
worry though. But I'm going there in my intellectual
Yeah,
exercise, which
yeah.
is, we there was a release yesterday that apparently, like, the Trump administration had met with the Albertans several times to sort of
Mhm.
say, hey, is there a way to strike a deal here, right?
Right.
So who knows, to your point, right?
Yeah.
But let's assume for a minute that trade gets made, right? And so you've got, all of a sudden this research-rich province from Alberta who's kind of like-minded with a lot of the current policies of the current administration. Let's say Venezuela goes well. Let's say Brazil eventually tips to a more US-friendly government again. There's a ton of talk about Cuba. Let's say there's regime change in Cuba and what's there
Right.
succeeds it is favorable. And so we've all of a sudden kind of taken a lot of the worries and headaches and pain points in the hemisphere off, and we get Greenland, or negotiate whatever Trump feels like he needs
Whatever.
from Greenland. But all of a sudden, it's sort of like, okay, we've got this somewhat self-contained hemisphere protected by two massive oceans, right? We put a Golden Dome, missile protection shield over the whole thing. Um, you can make a really interesting argument about what I guess we would call that Fortress America, big America, North and South America all together, right? Yes, it would still trade with the rest of the world, but it would be a lot less dependent upon what happened elsewhere, right? The need to get into foreign entanglements and all that type of stuff. And it could trade a lot within itself and then choose how to trade. It just could be really interesting,
Yeah,
right? And
no.
so let
Just think of the if we could just take, and we've talked about this before, but you think about the big problems in America, right? You have homelessness, you have poverty, you've got veterans that need all kinds of support, that served did their job for this country, and now they need support. But you just think about all the billions of dollars that we send to other countries and say, okay, we're going to stop that and we're just going to spend it all in America. What could you solve, right? What problems could you solve?
Yeah, and look, a couple things. First off, for Canadians listening, in this intellectual exercise, I think I'd like to do it where not we take Alberta from you, but we just find ways to work better together as countries. No one's looking to replace you
We
or
need to build
or,
bridges.
or, or, or raid your riches.
Right.
Yeah, and I think it's a great question, Lance. Although, personally, I think there are reasons for America to still be involved in the
Sure.
rest of the world, sort of as a force for
Absolutely.
good, but not as a manipulator. Um, but I agree, just, sort of with a Doge mindset, let's look at what we're spending all that money on and see, A, do we need to spend as much? And B, can we spend it more effectively? But also, too, the whole fraud, waste, and abuse thing, as we talked about the other week, like, yes, that's an important thing to look at, the offshore stuff. But I think just even domestically, as we talked about, I think if we can get abuse under control, I
Yeah.
don't think we have a deficit. Like, I think it is so large
I,
that if
I
we were to get that under control, we'd have a
I
balanced budget.
I absolutely agree with you. And the fact that we don't have accountancy on public finances is just absolutely mind blowing.
Me
I mean,
too. To me, that should be like, you don't get the money until you prove you have the system that's going to report to us exactly this.
yeah,
Yeah.
think about it this way, right? The IRS sends us a form and says, okay, tell us how much money you made, and so that we can tell you how much tax to pay. But if you report something that's wrong, they already have the data because then they come back and go, well, our numbers don't agree with you. You owe us this much more money.
Exactly.
So if they know that, then why don't we get so when we get our annual 1040s to send in, why don't we get a report from the government that says, here's our financial report from last
Yeah.
year. Why are we not getting annual reports from the government on where our money's getting spent since you're taking it from us to begin with?
Well, because A, our government doesn't balance its budget, and two, like its major institutions like the Pentagon, they fail their audits every year.
Yeah.
Yeah,
But
there's
again,
no accounting.
but this is the irony of the whole thing, right? I mean,
Oh,
it's just
exactly. Yeah,
yeah,
exactly. And the sad irony is that all this is eminently trackable in 2026,
absolutely.
right? Like we have the technology. It doesn't require us having to come up with fusion or quantum computing or anything like that. Like we actually really have pretty simple means. I mean, it's a big scale problem, but the technology isn't that tough to
Right.
just get, budgets and try to see if they balance or not. So anyways, it's ridiculous. It is self-inflicted and it's a rant for a different day.
But the fact that last statement on this, then we'll move on. The fact that we put up with it as Americans is beyond me. We just need to all come together and refuse to pay our taxes until we get an audit report from the government that shows a balance, where every dollar that we're sending in is getting spent.
So, Lance, what flavor cake do you like? Do you like chocolate? Do you like lemon? I'm
Yeah,
just
because
trying
you
to
need to put
figure
a
out.
file in it.
Pardon me?
You'll need to put a file in it to get me out of
Exactly. I was going to say, you tell me what flavor you like. I'll put a big file in there and send it to you in prison.
jail. I'm just saying.
All right. Here's my last question before we get to your trades and start to wrap up. So, uh, there's been some noise made this week again about the Trump accounts,
Mhm.
which it's funny. I find myself kind of conflicted on them. I love the idea of. I mean, it's a financial literacy, uh, initiative. It's trying to get people to think about saving earlier. I love the fact of what it could do. Um, but here's my question for you. Um, is this is this something else that contributes to the passive bid? Would this be another appendage of the giant mindless robot of just blind buying, month after month after month as new children are born?
Yeah. And does Nicki Minaj really understand what kind of financial commitment she's getting herself into? Does she has she put a pen to paper to see what matching the $1,000 per child could wind up being?
Being, yeah. I
I'm
actually
just
don't know.
curious.
Did she make a personal match? I know she's been at the White House, saying how much she loves the president and all that stuff.
Yeah.
But did
Well,
she actually make a commitment?
so I just saw a passing headline that says Nicki Minaj is gonna, contribute to the Trump accounts. So maybe she's gonna do 100 versus 1,000. But JP Morgan, Bank of America, quite a few others have all pledged to match that same amount. So, you know, in theory, we could be see accounts get opened up and funded with, three, four, $5,000, which is
Yeah,
great.
and it's probably it's I haven't really looked at it yet, but is it pretty much like a Roth? It's just that you can start it from birth.
Yeah. So basically, the programs for any U.S. Child with a valid Social Security number born between January 25th and December 31st of 2028, who has not turned 18 before the end of the calendar year of enrollment. That's the kind of the baseline. So they get $1,000. And then it works after that. It kind of works like a retirement account. It's supposed to be there until they retire and then they can draw out of that.
Okay, but you put money in at time zero, and that's when the
Mhm.
government puts its thousand in or whatever, right? And then I think you can there's matching, right? B of A might match for its customers.
Sure.
There's the money that you can put in as a parent. I
Yep.
don't know if it
5,000.
starts 5,000. Okay, does that
Yeah.
start at, and is that annually?
Yes, annually. So family, friends, and employers can contribute up to $5,000. I'm reading this, by the way, so
Yeah.
this is not off the top of my head. This ain't my thing, by the way. This is Richard Rosso's and Danny's thing.
Okay.
So,
Yep.
but friends, families, and employers can contribute up to $5,000 annually to each account, with some companies offering matching contributions as an employee benefit. So that's
Okay.
JP Morgan and Bank of America. So JP Morgan isn't contributing to everybody's accounts. They're contributing to their employers that match, or
Got it.
employees that
Okay.
match. So
Um, all right. And so you said up to age 18. What happens after age 18? Can you
so
still
they
put money in
can't
as an
access,
adult or it's capped? You're done.
well, no, so they can't access the money until they're 18, which is fine. And see, I think that's the big flaw in it,
Sure.
because at 18, the funds can be used for see, this is the problem we have with all of these retirement plans. 401ks fall into this. Um, these accounts fall into this, is that how many kids at 18 years of age, when they become an adult, are going to go, yeah, I think I'm going to leave that there for my retirement, or
Right.
how many of them are going to take it and spend it for, purchasing a first home, or, whatever.
Right. My wife, the therapist, would say, bad idea, prefrontal cortex not fully developed
Yeah.
yet. Right. That
So,
said, you're old enough to go fight and die for your country. I get it. You should be
yeah,
able to
yeah.
get access to your money. Yeah.
Yeah, no, look, but it's like a 401k plan, right? That's supposed to be retirement savings, but then we give you access for, all types of access for hardship loans and hardship withdrawals and all this other type of stuff. So it creates all this leakage in this retirement plan. People keep accessing it for all these various reasons the government keeps giving them, which is fine because the government gets their tax dollars from that. But it also erodes the future value of that retirement savings. This is why you look at the average 401k plan, it's like $60,000, which is less than 1 year's salary for most people. So, you know, this is a great idea, but it should be, this is like a Roth IRA. We're going to put $1,000 into this. It's going to be invested into an S&P index fund. You can't touch it. You can't do anything with it. And at 59 and a half, you can take your money out
Yeah. Sorry,
tax
last
free.
question on this. After they're 18, can they continue to contribute to this, or is it just whatever you've gotten by your 18th birthday, that's what grows from there?
No, my assumption is that once they turn 18 and take control of the account, it becomes like a regular account. And I can contribute to it on an annual basis or whatever I want to do.
So
Because
it converts like a traditional Roth
yeah, and
IRA?
I might be, look, and again, this ain't my thing. So I may be wrong on that. But that's kind of my understanding.
Okay. All right. I forgot there's one more other important thing we need to talk about before we get to your trades.
Mhm.
And it's I hate to use this analogy, but like in the Raiders of the Lost Ark at the final scene where the Nazis open the Ark and the angel comes out and they're thinking, okay, we've got our direct radio to God or whatever as they say, and then all of a sudden the angel turns into a demon and kills them all, right? The
Right.
guy's face melts, right? I think precious metals investors are kind of having that experience today. So silver's down to $90 an ounce right now. Gold, as we've talked, just basically dropped from basically 5,000 to 4,000, and it's been falling down all day before that. So, silver is down 23% on the day right now, from its all-time high from 24 hours ago. It's down
Right.
about 30%. So, uh, so we've been talking about this as the
Right.
precious metals have been, rocketing higher. You have been advising that folks take gains along the way.
Mhm.
I, as the guy who was quite bullish about the momentum behind silver, right, and the
Right.
guy who put on the silver laser eyes on his X profile.
Yeah.
Um, but I have been telling people as well,
Mhm.
hedge at least on the way up, one shape or form by selling or buying puts or however you want to do it. Um, and it's for this exact reason, right?
Right.
So price action doesn't go vertical forever. Usually, the more vertical it goes, the more quickly and viciously it contracts. I got to tell you, Lance, and maybe when we're talking here, you can pull up a chart of gold or silver in a second here. Um, but when I took those silver laser eyes off at 100, because I
Mhm.
felt like, look, we've all gotten way more than we expected. I'm rooting for silver to go higher. I personally think in the long run it we'll still see new highs in this. Um, but I'm like, look, I feel like it's getting to the point where it's not only being greedy to expect this to continue, but I feel reckless doing something like having silver laser eyes to indicate that I think it's a good time to jump into this trade. I didn't want people to jump into a trade I thought was maybe pretty long in the tooth in the short term. And again, for this exact reason, right? So
Right.
people who bought at the open yesterday are basically already down 30%, and we don't know yet where the floor on this is. But if you can pull up a chart of silver here, because this is the big question right now for investors, which is we've seen two previous spikes in the past, one in 1980, one in 2011, that look
Mhm.
similar to the run-up that we've had here. So, sorry, I don't have my glasses on, Lance.
Well, no, if you don't mind, can I start with silver? Can I start with gold real quick and then flip over to silver?
Sure. So let me just get the question out there,
Yeah.
which is this price activity that we've just seen, this latest vertical spike,
Mhm.
is it going to have the same complete pullback that we saw in the two previous years where all the gains were basically given up and then the metals were kind of went sideways? They were like dead money for a decade, or is something different this time? We don't know the answer to it yet, but if you look at the price action right now, at the start, it looks very similar to what the other two look like.
Right. And it's very important to understand math, right? Is that, people are talking about, oh, I'm up 100% in silver. A 50% gain wipes out, a 50% loss wipes out a 100% gain, right?
Right.
Those are the same. And people forget that. There's always that real famous chart that floats around the markets that shows the percentage increase in the S&P, and then you can barely see in the bottom there's these percentage drawdowns of the bear markets that occur. And it makes it look like, oh, you should just be invested all the time because, and this is the way it's put out. First Trust puts out this chart. And they say, well, see, this chart proves that you should stay invested all the time because the drawdowns are basically meaningless, compared to these massive, upsides that you get out of the markets. Well, the problem is that great, I can make if I go from 1,000 to 8,000 on the S&P 500, and then it goes from I lose 50% of that, I'm not down just $50, I'm down 4,000 points because it's 50% of that gain. And that's what we forget about the math. So again, you're down, say, 20% today, just rough math, right? When you're down 50%, you just gave up all the gains, right? So you're back to basically zero. So let me start with gold. Let me start with gold with this chart real quick, because this is a monthly chart going back to 1975, and it just looks at overbought conditions, where we are, deviations from long-term moving averages. This is a monthly chart, so we're talking about 4-year moving averages here. So right now, the 4-year moving average on gold is around 2,400 bucks. Now, I'm not saying it's going to go there. I'm not saying that at all. But historically speaking, the reversion back to the 200, the 4-year moving average is a fairly common event. In fact, most time it goes further than that. So, but you can see going back in history, these previous spikes, when you've been this overbought, you look at the top panel there with the RSI, the relative strength index on gold right now is the highest it's ever been on record ever.
Hmm.
And this is of yesterday's close. So this is not including today's close. So a reversion back to the 4-year moving average is about a 60% decline. And that's very much in line with these historical reversions going back through time. And again, when you start, so these bottom two charts is the deviation from the 4-year moving average. So this is the price deviation right now. It's 118% above its 4-year moving average. And the MACD is at a level we've never seen before history in terms of momentum. That's how much momentum's been behind this chase. So again, let's flip this over to silver, since that's the more pressing question right now. So this is silver. I don't have the lines on it and stuff because, so I want to show you gold first because I had it all mapped out for an
Yep.
article I was working on. But you see the same thing here. Relative strength is at a level we haven't seen since really, 1978. And these previous spikes, in every case, have given up some, most, or on a percentage basis, have given up some, most, or all of their previous gain. So again, you look at it here and go, well, it's a lot higher than it was in 1970. True. But a reversion back right now would put gold around $30.63 a share, which is where the
Silver.
four-year
Yeah.
moving average is.
Yeah. Silver.
And
Okay.
and $30 a share is about where silver should probably trade from an economic basis. And importantly, silver may hit new highs at some point in the future, but as you can see here, it can be very, very long periods in between highs.
Yeah. By the way, you're saying per share, you meant per ounce.
Per ounce, sorry.
Yeah.
Yes. I'm
Yeah.
a
That's
stock
okay.
guy. So
Yeah. And look, folks, so Lance is telling you what could happen. I understand the many, many reasons why people have been saying it's different this time. And of course, that's what Lance and I have been
Mhm.
batting around the past, month or two here as the metals have really rocketed is you got to be careful when you say that because it oftentimes isn't truly different this time. Now, it very well may be in the precious metals, folks, and I am hoping it is. Like I said, I'm still hoping for higher silver prices, and I did expect a pretty violent pullback. And this is not really surprising me. Like I said, when I took the laser eyes off at 100, I was thinking, okay, this thing could drop to 80, 70, whatever, maybe even lower an ounce, because that's the type of pullback we're risking with the vertical action we have here. TBD from here, Lance, I've been asking a lot over the past 24 hours to folks as the metal's been correcting, who are in it, who are in the soup. Do you expect this to be like the previous two blow-off tops? And most are saying no, and they've got a bunch of reasons for it, and we'll find out whether those reasons prove true or not. I think we have to be at least somewhat mentally prepared that what Lance said could happen. I mean, there is a potential here that it is not at all different this time, and we just go back to historic averages. And I know that's scary for a lot of people who bought in at 100 and we're super psyched to see it go up, within a day
Right.
or two, and then are thinking, oh my gosh, you're telling me it's two-thirds of it still left to be lost. Who knows? I'm not saying that's going to happen. I'm just saying it could, and we need to be cautious. But at the end of the day, this comes back to the boring, unsexy stuff that you and I, Lance, have been, telling people, which is, hey, you want to not get caught up in the emotions first and foremost. You want to trim your gains as the universe is kind enough to give them to you. And to my point, you want to hedge. If you're not actually selling, then if you're kind of like someone like me, and Lance and I had this debate last week, I don't want to sell my ounces, right? But I had a big exposure to the price, right? If the price went down, it wasn't going to make me happy. So, hedging against that, the case I was talking about was with puts, is a way to kind of keep your position, but protect yourself against at least some of the downside. So anyways, I know folks don't love it when we bring up those boring reminders, especially when, the price was vaulting up by 5% a day, the way it was over the past, week or so. But
But that
this,
was your warning.
pardon me?
But that was your warning.
That was the warning, yeah. And this, like today, days like today, where, like I said, silver's probably getting down close to 25% today on the day, is exactly why we were beating that drum, right? So we're not here to say I told you so, or to gloat. And trust me, folks, this is still hurting me on a net basis, the price action. And I'm still rooting for these precious metals. But what's going on today is exactly why Lance and I keep beating on the risk management, risk mitigation drum.
Yeah. I want to show you a chart. And by the way, I don't care where silver goes from here. That's it. I trade it as for what it is. It's an asset that I
Yeah,
traded.
to you, it's just
Big one.
just another asset that's in your portfolio. Yeah.
Exactly. Right. I don't buy into all these narratives. I think they're a bunch of funk, but you know, what drives the price of commodities at the end of the day is futures. And this is all trade all prices are traded on futures markets. So when you're buying you're buying gold or silver or whatever, the vast majority of that price determination is driven by the futures market, which is heavily leveraged. So when that market reverses, that leverage unwinds very, very quickly. And when you start seeing things gap up 5 or 6% a day, that is always your warning sign to get the
Yeah.
hell out of whatever it is you're in, because that's that speculative surge. This chart right now, so this was a chart that was out on Wednesday. This is the silver ETF volume for trading the silver ETF SLV versus that of SPY. And the volume of retail investors buying SLV surged to the same level as you saw on the S&P 500 just last week,
Mm.
right? So in other words, all the retail investors, and this is all showing up on Reddit now. And look, when things are getting on Reddit, where these young kids on Reddit are going, oh, you need to buy silver, it's going to the moon, and they're putting little rocket ships by it, etc. That's a great sign that you need to start getting out of whatever that investment is. And again, it doesn't mean sell everything, but it does mean take some profits and rebalance your risk, maybe invest some dollars somewhere else, and just manage that issue. And this was our conversation last week. So you've got a bunch of physical silver sitting at home as an example, and like I don't
Yeah.
want to sell that. Well,
Not at home, just FYI, just to be
well,
clear.
no, no, I'm not saying you. This is ubiquitous you. I'm saying you personally.
Oh, okay, okay, okay.
So, but this is a conversation we had last week. And yeah, it's under his bed, just to the left of his pillow. So just you can't
Yeah,
miss
yeah,
it if you go in the house.
yeah.
Um,
It's right under the big frame I have of Lance, the portrait I have of Lance,
exactly, an arrow
right next to
pointing
my
down,
bed.
silver here. But so you have all this silver sitting at home or in the bank or wherever it is. When you have these opportunities, you should sell the physical. Because again, if you go into a period of 30 years or 20 years or 10 years where the price is much lower than where it is, you've just destroyed capital value that you could have capitalized on. And then you could have taken that value of that asset at much higher prices and then bought the physical back later at much cheaper prices and then trade that cycle again. Because what's clear from the chart on silver is it trades these cycles on a regular basis. But there's a economic level where silver is very important to the economy, right? Making everything that we make, supply demand imbalances, all those type of things. So when the futures markets break and you start bringing prices down very sharply, it potentially hampers the recovery because now all the people that were long that leverage are now underwater, so they have to start liquidating. All these retail investors will start liquidating at some point. Now, again, probably not tomorrow, not next week. I think you're going to see a bounce in silver over the course of the next week or two. But if that bounce in silver fails to make new highs, it's probably going to go lower in the next roll. So again, that's
Mhm.
just how the futures are going to work. But if you start sparking this unwinding of leverage, because we're seeing a lot of retail investors right now, they're buying SLV on margin and then buying like 2x long SLV on margin, those type of things. That unwinding that leverage can get really vicious really quick. So
Right.
just understand that all I'm showing you is again, I have no hunt in this game. We own silver and gold in our portfolios, or in our all weather portfolio, we've taken lots of profits in that. But that's my only hunt in this game. And I'm just worried about ultimately, can I do something better with that money in the future?
Yeah. Okay. All right. Well, look, we're gonna have to wrap it up. Start wrapping it up here. I'm gonna punt the rant for the week again. But so real quick, let's trades. What trades did you guys make this week, if any?
So going into earnings, so this week was the beginning of earnings week, and next week we're going to have Amazon and Google and a bunch of other companies. By the end of next Friday, we will have, and this is also another big part for the market that we didn't talk about yet. But this market weakness that we've got going on, don't forget that we have no buybacks
Right.
right now.
Yep.
Everybody's in blackout. As of next Friday, we'll have 80% of the S&P 500 will have reported, and the buyback window will begin to open back up. So we're
Mhm.
about to get that buyer coming back in. That's expected to be $1.2 trillion this year of corporate buybacks coming into the markets. So we're going to get some support from buybacks after next week. So we may see this market stabilize here just a bit. Um, but so this week, though, going into earnings, Palantir reports next week, a couple of other companies that we own. We took profits in Palantir and Palo Alto Networks, some JP Morgan, and one other company, and I'll try to remember what it was here in a second. And we bought a very small kind of starter position in Apple going into earnings. But that's basically we just took some tech profits going into earnings because we were worried about negative volatility risk, which worked out to our advantage. And we bought a little bit of Apple, so we'll see how that trade plays out over the next week or two.
Okie dokie. All right. Thanks so much again just for being so transparent every week on that, Lance.
Sure.
All right. So we'll
Sometimes we make
skip.
mistakes.
Okay. We'll skip the rant, but I do just want to say a huge thanks again just to this audience. But Lance, I was at the Vancouver Resource
Mhm.
Investment Conference this past weekend. It's a crazy time to be there because the precious metals were just on fire, right? And
Everybody's happy.
Sunday while we were there, and then when the futures market opened, and it just kept gapping up and gapping up. It was pretty amazing. But the absolute best part of the experience for me was the just surprisingly large and just it's so overwhelming to me. Large number of people who were coming up to me and wanting to say, hey, this program has really made a big difference in my life. Either because they didn't have a lot of financial literacy before, and they went online to sort of try to start educating themselves. And somehow YouTube, showed them one of these videos, Lance, and they just started watching,
Mhm.
and they feel like they've really learned a lot, way more, heard this a lot, way more than they learned in school, right? Um,
It's not hard because they don't teach anybody anything in
well,
school.
exactly. I mean, we've railed about that forever. And there were, not a small percentage of people who came up who said, I've been listening for years, and it's really made a big difference in my net worth. And I love hearing that. I mean, the main
Yeah.
reason why we're doing this, the mission of Thoughtful Money is to help people better fund their life goals, right? Period. So at the end of the day, we want to hopefully enable you to make more informed decisions so that you can get to your life goals faster and more with greater probability. And to hear that people are actually doing that, it just means the world to me. Because again, that's the whole reason why we started this thing. And then let the people who are like, oh, I've got an hour commute every day, or every
Mhm.
weekend I go visit my mother who lives a couple states away or whatever, and I listen to you and Lance. It's a perfect time for that 2 hour trip I have or whatever. And so it's such an honor. I just want to say to those of you who are listening that you guys let us into your life and have made us in some way, shape, or form, a part of your weekly experience. There is a family aspect about that, and Lance, it is really disconcerting. I have learned that I probably do, in my wife's words, really overshare my life, both on this program and on X.
Trust me, I've gotten in trouble with that with my wife too.
Yeah, yeah, because people will come up and they'll make very specific comments about things I've done. It takes me aback for a second, like, how do you know that? And then they're like, well, because you said it on an interview with Lance, or I saw it on your
Mhm.
X feed. But it is such an honor that we have these friendships, and we people have really gotten to feel like they've gotten to know you really well as a person, and certainly the trials and tribulations and hopefully triumph that you're going through with your wife, with her cancer and all that stuff. I do just want to tell folks, it is it is not. We are not unaware of the investment that so many of you put into this program, not just the time, but in some cases the emotional investment. And again, it means the absolute world to me, and I'm sure Lance, you feel the same way.
Oh yeah, absolutely.
Yeah. All right.
Absolutely.
Well, look, folks, we'll start wrapping it up. A couple of things. I've been so snowed under recently. I'm really getting behind on some important things. One of which is kicking off the promotion for the upcoming Thoughtful Money Spring Conference. So, folks, I'm going to do a little pre-promo for it here for the next 30 seconds, and then you're going to get something from me very quickly via email. But as you know, we do this twice a year. We have most likely the strongest faculty we've ever had lined up for this year's. And given what's going on right now in the markets in real time and in the world in real time, this one might be the most timely one ever. And I will, in the email that I send out here and the official announcement I'll do on this channel at some point soon, I'll go through the entire faculty that we have lined up right now. But it's pretty amazing. We've got Lacey Hunt as always kicking it off with his graduate level keynote. But then this year we've got Ed Dow joining for the first time. We've got Matt Taibbi joining. We're obviously going to have Darius Dale and Michael Howell and Judy Shelton again, who apparently was like a kind of 11th hour. I think I heard that Trump or the right before they decided on Warsh, they brought her in like the day before, or whatever. I think just to check to see if maybe she might be the one to try to squeak
Mhm.
in at the end here. So I mean, we've just got so many heavy hitters coming this year, and their area of expertise is on all the key things that are going on right now. So should be fascinating. I don't have a link to drive you to, or I don't have the official link to drive you to, but if you want to buy your ticket right now for the conference, I put up a link at the end of the last one where you can buy tickets to this spring conference at last conference's price. I'm trying not to increase the price. Hopefully, I'll be able to do that this year, but I haven't made the final decision yet. So I can at least guarantee you can buy your ticket with 0% inflation if you go right now to thoughtfulmoney.com/2026. And then again, like I said, probably hopefully within the next couple of days, you'll get the official announcement from me with all the additional color around what to expect from the conference. Um, let's see what else. Well, I guess just as usual, if If you're thinking this year is a tricky year to get through and you're looking for a steady hand at the tiller to help you do that, then maybe you should just keep watching Lance Roberts on this channel week in and week out. And so to do that, just let them know that that's going to be your plan for the year by hitting the like button and then clicking the subscribe button below if you haven't already, as well as that little bell icon right next to it. But specifically about getting, some guidance here for this year, especially if maybe you've been, a little bit rocked by what's going on in the precious metal space right now. I highly recommend you get that guidance from a good professional financial advisor. Importantly, one that takes into account all the macro and market issues we talk about here on this channel. If you've got a good one who's doing that for you, great. Don't mess with success. But if you don't, or you'd like a second opinion from one that meets that criteria, then consider talking to one of the firms that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. Perhaps you'd even like to talk to Lance and his team there at RIA. To do that, just fill out the very short form at thoughtfulmoney.com, and the firms will be in touch with you very swiftly after you do that. All right, Lance, thanks so much, buddy. End of another week. I think we're getting you out of here at the right time. But again, just thanks for being a steady hand on the tiller here. Thanks for being as boring, dull, and unsexy as you are.
Yeah, hey, that's my life's motto: boring, dull, and unsexy. My wife says that all the time.
I was thinking that's what she said.
Exactly.
All right, brother. Have yourself
All
a
right,
great weekend.
see ya.
All right, everybody else, thanks so much for watching.